Now, on a year-over-year basis, it is down to 7%. But if you look at the growth on a quarter-to-quarter basis and then annualize it, we're at half that growth rate. In fact, less than half of that growth rate. So that tells you what's coming here. The rate of velocity growth is slowing down and is no longer a buffer if money supply growth is negative or weak. And it is very weak now. In fact, if we took the rate of money growth at 0.6% on a year-over-year basis, and if that 7% in velocity growth drops to roughly 3.5%, which is where the quarter-to-quarter growth rate is going, then there's very little room for GDP growth. 3.5%, 3.5 to 4%, it accommodates both real growth and pricing. Is it 2 and 2 or 1 and 3? We don't know. But the history of velocity is...
Don't forget to subscribe, traders. Let's continue with the interview to analyze it later and also comment on some of the most important news of the day.
Once in motion to the downside, it keeps going and we end up in a recession. So we have been saying for quite some time, we're in a rolling recession. Housing has been in recession. Autos are in recession-like conditions. Commercial real estate, office, and now even more multifamily, which is much broader based, in what we believe is a recession. We think consumption is entering a recession. Now, during recessions, consumption does not fall apart unless we're in an 08-09 period. But it has been slowing down fairly dramatically here. And we believe we're moving towards a flattish consumption environment, which is very weak. And we do believe that is why pricing is going to come down.
Economic indicators suggest a potential recession, with various sectors such as housing and automobiles exhibiting signs of downturns. The housing market, typically a bellwether for economic health, is facing challenges that could be indicative of broader financial stress. Similarly, the auto industry is experiencing difficulties that mirror recession-like conditions, reflecting decreased consumer confidence and spending. Moreover, overall consumption is slowing down significantly. This deceleration in consumer spending is a critical factor, as it plays a central role in driving economic growth. The current trend suggests that we may be heading towards a period of stagnant consumption, where growth in consumer spending remains flat. Such a scenario can have widespread implications for the economy, potentially leading to slower economic growth and increased uncertainty among businesses and consumers alike. In summary, the convergence of these signs, a struggling housing market, a faltering auto industry, and slowing consumption, paints a picture of an economy that may be on the brink of a recession. It highlights the need for careful monitoring and potentially proactive measures to mitigate the impacts of these trends.
The other thing that's come out, of course, and importantly, we've been talking about Nvidia for a while, no question, has been the most important force in unleashing the AI age and empowering companies like OpenAI and Anthropic and Meta with its open source Llama 3 platform. So very much believe that Nvidia has led the charge here, and all praise to Nvidia. But what we've been saying for some time now is that if Nvidia is going to continue to appreciate at its recent rate, which is quite extreme, of course. I think those of you who know us know that we wrote it for a 100-fold move, and we've missed a 3-fold move. That is what happens as you move into parabolic momentum moves in the market, and everybody jumps on board. But if that is right, the parabolic move here, then we better see some big gains in other companies. And we thought we would see them in the last few quarters. We really haven't. We really have not. Now, what we may be seeing, and we need a few more earnings seasons to determine this, is productivity is increasing. So right now, first order effect is productivity is increasing, better, faster, more productive, more efficient, more creative products and services coming out of generative AI. Maybe that's happening, but it's not clear cut yet. So the picks and shovels, which is how we group and many people group Nvidia, picks and shovels has been the first mover, no question about it. But in order to sustain that move, we need to see some real gains, real benefits elsewhere. So, there are puts and takes with each of these stocks.
Nvidia has played a crucial role in the development of artificial intelligence technologies. Their cutting-edge graphics processing units, GPUs, have provided the computational power necessary for training and deploying sophisticated AI models, making them an indispensable asset in the AI industry. However, while Nvidia's contributions to AI have driven significant advancements and their stock has appreciated as a result, maintaining this upward trajectory in stock value may require ensuring that their innovations benefit a wider range of industries beyond just AI. Broadening the application and impact of their technologies can help sustain growth and secure their position as a leader in both AI and other emerging fields.
And we think generative AI is truly disruptive. So the idea that the crowding into the Mag 6, the Magnificent Six, which are basically these stocks, to the exclusion of so many other stocks, is, we think, questionable. And by some measures, and I think I mentioned this before, we've never seen this kind of crowding in before. Not even during the Depression, when people were worried about companies going bankrupt. They crowded into just a few stocks. We went higher this time around. That's a Goldman study, and we'll present it at the next.
Generative AI is significantly transforming the stock market, acting as a highly disruptive force. Historically, investors have shown tendencies to crowd into specific stocks, but the current levels of this phenomenon are unprecedented. When we compare the present situation to past market behaviors, we find that the extent of stock crowding today surpasses even the extreme levels witnessed during the Depression era. This observation is not merely speculative, it is backed by a comprehensive study conducted by Goldman Sachs, which highlights the extraordinary degree of crowding occurring in today's market. The implications of such concentrated investments are profound, influencing market dynamics in ways that were previously unimaginable. As generative AI continues to evolve, its impact on stock selection and investor behavior will likely deepen, further intensifying the crowding effect and reshaping the financial landscape.